Ladies and gentlemen, welcome to another Coffee Microcaps Fund Manager interview series, and I'm delighted to say we're joined by Paul Palumbo today from Acorn Capital down in Melbourne. Paul, how are you going on?
Well, thanks, Mark. Looking forward to the chat.
Yeah, and a bit like our last one where we were with Peter Johns from West Ferry. We've got two stocks who haven't presented on Coffee Microcaps before, but two I think interesting ones for different reasons. We might kick off with the smaller of the two, Microx. Paul, maybe just kind of give us an overview of, for people who are not maybe familiar with the Microx business, first principles, what did this business do, and how do these guys make their money?
Yeah, thanks, Mark. So Microx has been listed since 2016 on the ASX. So it's been around for a while, and it's probably caused shareholders some grief along the way, because the core of what they do is they're an advanced manufacturer, and what they manufacture are electronic X-ray tubes. So if you think about sort of X-rays as an imaging modality, there's X-rays in the security market, X-rays in healthcare markets. CT scanners are essentially just X-ray tubes on an articulating arm. They all use a heated filament X-ray tube. It's been done for a couple hundred years now. Microx have really taken a very different approach to the way X-rays actually work, and they use what is called the cold cathode technology. So essentially, this is carbon nanotubes that are used to generate the electron beam that then creates the X-rays. So it's basically like the same way an LED light has replaced fluorescent lights. This is the next generation X-ray tube. It's worth pointing out that when Microcaps first listed, they were really an R&D company, and that was all about trying to get manufacturing scale of these X-ray tubes. Over the journey, it hasn't probably gone to plan for them, and they've had to basically insource all of this know-how, this technology, into their site in Adelaide, where they now manufacture a whole range of different electronic X-ray tubes that support a range of products for both security markets and healthcare markets. And the reason the company wants to go down this path is because once you master the manufacturing of carbon nanotubes for X-ray purposes, you can create a whole different range of products that are much lighter. The X-ray tubes can be significantly smaller, and the actual control you have over the X-ray is very precise, as opposed to what current technology does. The first product in terms of revenue generation has been a mobile X-ray cart. So you may have seen in hospitals where clinicians or caregivers are pushing around an X-ray machine. Using conventional X-ray technology, that's about an 800 kilogram device you've got to push around. To put the advantage that the Microcaps has in place, their equivalent device, their equivalent mobile X-ray machine, which they do call the rover, that weighs 95 kilograms. So there's a significant advantage in usability and life of the cart. The reality is the market's been disappointed with how commercial sales has gone for the rover, and there are interesting reasons to understand why that is the case. But I think what the market overlooks is the validation that the rover gives to their underlying technology. Medical imaging, that is the highest grade imaging you can have in this market, and their sort of cutting edge technology, their carbon nanotube X-ray tubes, have been accepted by the medical community as a technology that they will provide medical imaging services for, and that has opened up a whole heap of other markets for Microcaps. So while mobile DR or the mobile X-ray machine is interesting, it's actually about the other products in the pipeline that are coming to market as we speak that has our interest.
Okay, and yeah, maybe if we just expand on that a bit in terms of, kind of your thesis around why you like, say, Microcaps at this particular juncture? Is it because they're kind of on that nexus of R&D into commercialization, or is it the fact that, as I think we were chatting just before we came on, and I first remember Microcaps, they were very defense centric business, and healthcare wasn't really in the picture, whereas now they're attacking both those markets in a variety of different ways. Is it kind of a combination of all that kind of why
it is a combination,
or is it more on a pure kind of valuation basis?
No, it is a combination. I think at its core, Microcaps has a real platform technology. So the actual they do the X-ray tubes, but they also do the generators as well that you need in any of these products to actually generate the images. So they have this platform that they can then, as engineers, develop a whole range of products. And it's the platform itself, like the underlying technology, that I feel has been externally validated. So Varex, which is the largest X-ray imaging components company in the world, they've taken a 10% stake in Microcaps, and they themselves have been trying to do their own carbon nanotubes very unsuccessfully, and have ultimately pivoted and gone with Microcaps. So I think that was a real validation point of this underlying technology. The Department of Homeland Security in the United States, they've always been interested in carbon nanotube technology, but have been skeptical. And it wasn't until Microcaps had demonstrated with over sort of 500 units in the field of their mobile X-ray machine, so medical imaging applications, that the Department of Homeland Security in the US has now engaged Microcaps to lead an airport self-passenger check-in opportunity, which is the really jewel in the crown of their product portfolio, which I can talk to later. But step one of the investment thesis is underlying technology has been validated by external parties. They are the world leaders in carbon nanotube technology. The second aspect, and as you alluded to, is really how Microcaps has progressed, is now progressing into a commercialization stage company. When it first listed, it was really an R&D company trying to find its way, trying to get its manufacturing processes bedded down so it could really scale up. And they had a few false starts along the way. But they are now absolutely in a position of having mastered that core technology piece and the manufacturing piece. And it's now about, let's go and sell this technology, not just in the in a mobile DR machine, but the next product that is literally about to launch is in the defense market, and it's called their Argus product, which is all about bomb detection. And it's a very unique product. So while there are other mobile X-ray machines, there really isn't an equivalent product to this Argus bomb detection product. And the key sort of functionality that really differentiates Microcaps from anybody else in this defense market is the ability to X-ray suspect packages without requiring to put a detector plate behind the package. So traditional transmission X-ray, you generally have to have that plate behind the object in order to capture what rays or gamma rays are actually getting through to then produce the image. Using their carbon nanotube technology, Microcaps can basically put their device, their Argus device, on a robot or a remote control vehicle and come up to the package, image that package without requiring a person to put themselves at risk, and get the detector plate behind the package. So the Australian Defence Force has always been really interested in this product. Groups in the US are very interested in this product, and it is now about to sort of commercially launch. And it's a 65% margin product with really no competition. So they can own this market, which is about, my estimates, is about $100 million US market. Further to that, in this pipeline, as I said, it's a platform technology. Microcaps has been funded for two other commercial products. So the Australian Stroke Alliance is funding the development of a mobile CT head scanner, and this is for the detection of stroke. And as I mentioned, the Department of Homeland Security in the US, they've just announced a 3-year funding deal for $21 million to develop this self-passenger checking at airports, where Microcaps is the lead contractor and brings a mobile baggage scanner sort of technology to the overall solution. So a whole range of products, one platform.
Yeah. If we maybe flip the coin a bit into the, some of the risks that go along, as you say, in the intro there, it's a business that has caused shareholders a bit of angst over the time, and from my own experience as well, these commercializations don't normally go as smooth as possible, with customer delays and distributors not living up to promises that they've made back to somebody like Microcaps, the OEM, and changing distributors. And if we're kind of looking for negatives to this story, or risks that people should be aware of, in your mind, kind of what's front and center for looking at Microcaps from that perspective?
Yeah, there's definitely commercialization risks. I do believe a lot of the manufacturing and technical risk has been dealt with, and now we're moving into the commercial realization that the market that we expect, let's take for Argus, the bomb detection device, we do expect that there'll be fairly rapid uptake because of the unique positioning of this product. But that is yet to be tested. We are literally getting the product into the hands of potential customers now for those sort of trials and demonstrations. So there's a risk that there's something in the product that isn't accepted by the market. We haven't been able to tick that off just yet. On paper, it all looks great, but there isn't. We are not yet selling, or the company's not yet selling the product. That's really a next calendar year story. The business is relatively well capitalized, but is always having to manage their cash flow. So there's questions around, as you scale up commercialization, do you have the capital to support it, the capital and the infrastructure? So there is a risk around timing and the ability to get that return on the sales and marketing investment dollar. That, to be fair, the market has a question mark on it, because historically the commercialization hasn't been the strong point of Microcaps. It is under new management. So the old CFO, Kingsley Hall, has now stepped into the role of CEO and has a very clear mandate from the board to really monetize the asset base, or the IP that the business has. And there's no guarantee that we're going to get the returns that we are forecasting, because there is competition in the market. I estimate that Microcaps is 3 years ahead of the curve. There's a listed player in the US called Nanox that has a different underlying technology, but same sort of approach to the cold cathode X-ray tubes. But in terms of power, are well behind what Microcaps are doing, so that the types of imaging is restricted. But the competition will come. So if they don't execute well, they will lose the advantage they've got at the moment.
Yeah. And in terms of if we do look out, let's say 12, 24 months, what are you really looking for from the business over that time? Is it as kind of a steady uptick in revenue and cash flows, kind of quarter on quarter, half year on half year, from sales of rovers, initial sales of the new products
Argus,
Argus and others that might kind of come to fruition. Is that and more of these maybe contract deals where they're the R&D is being kind of pre-funded, if I can say that, it's not coming off of Microcaps's balance sheet?
Yeah. So if you look at so take FY23, their revenue number was about $22 million. 15 of that was sort of product sales and engineering services. The bulk of that was engineering services, and then there was about $7 million of essentially R&D funding. I do expect they'll continue to receive quite meaningful R&D funding for both the brain CT scanner and the airport security project. As mentioned, they've signed a $20 million 3-year deal with Department of Homeland Security. But I am expecting a reasonable cadence on a quarterly basis once Argus comes into market of product sales across both security and healthcare. And so to get to the point where they're covering their operating expense through those two products, they're actually not that. It's sometimes difficult to look at their accounts because there's this R&D tax credits and funding and product sales. They are not that far away from a cash flow break-even position, and I do expect on successful commercial execution will be there within sort of 12 to 18 months. The other catalyst I do believe I expect to see is in those funded products, there is a lot of industry interest in what they're doing. So from a monetization point of view, noting that the new CEO's mandate from the board is to monetize the asset value, I would not be surprised if we see some joint ventures or spin-outs coming from Microcaps to then provide further funding for these very large opportunities. I mean, the airport security opportunity is a multi-billion-dollar market for them. I expect they'll partner to monetize that. So that's another value creation opportunity.
So we might see JVs in the mix there.
I think it's highly likely.
In terms of if we move on to the second one, a business people might be familiar with, it's been listed for many years now. As
there's a theme.
I'd say maybe mid 2000s, maybe even. Could we be going back that far? Yeah. I can't remember exactly the IPO, but it's definitely been around for over 10 years. ImpediMed, for people who might have heard the name but not 100% familiar with what they do, or might have lost track of it over the years, maybe just say a quick 101 on ImpediMed and what they do.
Yeah, in a real nutshell, ImpediMed is a medical device company that uses bioimpedance spectroscopy to basically measure very small changes in fluid levels and tissue composition within your body. So that's the underlying technology. People would be familiar with bioimpedance analysis, which smartwatches use it. In gyms, there's devices that do this, where you stand on it and electrical signals are sent through your body. The difference with what ImpediMed is doing, and this is patented technology, is they're using 256 frequencies versus 6 to 8 frequencies is what you would get in a typical gym device. And the way the algorithms or software works to actually calculate those very small changes in fluid levels is very different to the way standard sort of estimation is done on your sort of gym-based device. So the reason we like ImpediMed, and it has been around for a very long time, and it's probably it's similar parallels to Microcaps in where they've disappointed investors based on sort of commercialization sort of objectives. However, where the company is placed today, you really do need to have another look at it and appreciate how strong a position it is now in. In addition to the actual technology that they have, which is patent protected, it's really the clinical data that has finally come out and been peer reviewed and has been critically evaluated to show that their technology, this is first applied to the prevention of lymphedema. They have showed that their technology is clearly superior to the current standard of care, which is a very crude measure of using a tape measure. Lymphedema is essentially a build-up of fluid in your limbs, and you'll see very excessive swelling that occurs. And the thing to understand with lymphedema is it is reversible in the early stages if you pick it up early, but becomes irreversible if you let it go too long. And then the patient is left with lifelong, quite large swelling of the limbs. Specifically, ImpediMed is focused on breast cancer-related lymphedema. And that's typically because the treatment for breast cancer damages your lymphatic system, and then you are at risk of having this swelling. So their 3-year trial, 1,200 patients, clearly demonstrates the superiority of their objective measure. The actual device is called SOZO. It was originally called LDEX. So that is now out there, and that took a very long time to complete, much to the frustration of the market. But what that clinical evidence now does, or has done, is the NCCN guidelines, so in the US, the clinicians will typically abide by what the guidelines say in treating a patient. ImpediMed's SOZO technology is now written into the cancer survivorship guidelines. So basically, wherever a patient is at risk of lymphedema as a result of cancer, not just breast-related cancer, then the recommendation is that they are monitored using the SOZO device to prevent lymphedema. It's a very, very significant announcement for the company. It was made in March of this year, because what that then unlocks is the ability for the insurance system, the private payers, to then cover or reimburse the scanning of patients to ensure you do catch it early and prevent lymphedema from forming. So what does all that mean? After all these trials and tribulations of developing the technology, getting the clinical trial completed, showing the results were superior, getting into the guidelines finally, I think it was their third or fourth attempt, and now where we are today, really getting national coverage. So they're about 40% covered in the US in terms of private pay. The company has stated they expect to be around 50% at the end of this year and 90% by the middle of next calendar year. It just creates a very, very unique position for this company to really go and capture that billion-dollar opportunity that sits in the early detection of lymphedema. I would highlight that the other attractive sort of feature of ImpediMed is the business model. It's moved from a device and consumables model to essentially software as a service. So they do sell the SOZO device, and they sell it on 3-year contracts where they're typically billing about $1,000 a month on average at the moment. But you can see just with the what they call their step pricing model, by year 3, they'll be charging $2,000 a month per device. And this pricing was all set prior to inclusion into the guidelines and the private pay. So what we do expect now is an acceleration, and this is over the next sort of 24 months, because the first priority is to get private pay, but there will be an acceleration of devices installed into the health system, and the rate at which that monthly rate will tick higher year on year. So much so that the economics are actually quite favourable to the healthcare system, where you can save money yet have hospitals make money by scanning the patients, and that is delivering the highest standard of care. So it's a very much a win-win-win situation, which is really unique in the ASX.
And in terms of the big government Medicare in the US, I know a lot of firms have tried for many years to get I forget the name of the actual codes or whatever, but that is a real, as big as the private insurance market is, that is also a huge market that kind of once you've kind of got your approval from the FDA, a lot of companies I've seen go chase that down, and a lot of them unsuccessfully. ImpediMed, that opportunity on the Medicare side, trying to get the code approval that within the kind of more public funded space, that is that opportunity something they're chasing now, or they kind of solely focused private market first, will worry about the government funded market later?
So there is an existing CPT code that is utilised within the Medicare. Yeah, and so that's about $150 US per scan. So that is available today. What wasn't available was the private pay, and we need to see where the policies land, but there is an expectation that that's going to be north of $200 US a scan. So the market, both public and private markets, are available to ImpediMed. There is no further sort of process that they need to go to other than get the insurers on board, which is that they're falling over very quickly because it's now standard of care, and the clinical evidence is very clear that if you want to provide the highest standard of care and ensure you minimise the risk of your patient, developing lymphedema, you need an objective measure, and it actually specifies SOZO as that measure. So they're in a very, very strong position. The risk, I'm not sure to ask about the risks, because there clearly are risks that, it's not all a one-way street. They've recently experienced a board spill, which was an interesting experience, to be honest, because the company's never been in better shape, yet the board has just been kicked out. We need to keep an eye on what is the result of that. Part of the board spill is questions around how quickly the company will execute and spend its shareholder capital, because so much capital has gone into the business over the years. There's a sense that they need to just be not go too aggressive into this market. So we need to see whether the strategy evolves under the board. Management remains the same, and we do regard management quite highly, and are supportive of their strategy to really try and capture 10% of this billion-dollar market over the next sort of 3 years, working on a cost base of somewhere between $35 and $40 million per annum to have the infrastructure to then capture that market. I actually don't think the strategy is going to change, but we just need to be mindful that a new board has come in and there's that process of board and management getting to know each other. I also think there is a land grab to be had. So yes, you need to manage shareholder capital prudently, and this is an execution story now, but it's not going to be their own playing field forever. Competition will come in. But I think they've got a 3-year head start, given that their trial took 3 years to actually to run. Not because of errors, because you need that time frame to demonstrate the clinical utility. So they've got a head start, but it's not going to be like that forever. So there is a balance between how hard you go and how quickly you establish your sort of dominance in a land grab. And this needs to all play out. We also need to see where that pricing per scan, the pricing per month per device, how that can ratchet up, because the economics are fairly attractive for the high volume clinics, where you could see not $2,000 a month, but $4,000 a month US for each device that is placed. So that also is something that we just need to be patient on understanding how that changes.
And I guess similar to Microx is one of the risks, capital to kind of fund this, expansion, growth, rollout, whatever, getting devices in, and sales and marketing support, software support, all that kind of back end stuff that goes with, having, done all the R&D, but now we got to support customers with, problems, troubleshooting for them on a daily, weekly, monthly basis.
It's interesting. So no, they don't have that. When you compare Microcaps and ImpediMed does not have that sort of capital constraint. They raised capital not that long ago, relatively soon after getting inclusion into the NCCN guidelines, and the company's justification was for exactly the points you were making. We need to scale up. This business doesn't have the internal capabilities just yet to support the size business that it could be, given the market opportunity. So there needs to be investment in sales and marketing. We only have 6 people at the moment. That's going to rise to probably over 15, on its way to 30. There's the whole sort of rollout, implementation, support. There's medical affairs. There is an investment that is required, and that partly is a risk. But the company raised capital in order to support this. And ironically, that is actually what has created the board spill. There has been some shareholders who felt that they should have waited to do that capital raise, and that you need to pace that level of investment so that shareholder funds are preserved. So the funds are there, it's sitting on the balance sheet. It's really a question of how quickly are they deployed and how effectively. So it's not a risk, and I do think management have done this before, the new management. And as long as they've got a good professional working relationship with the board, I think it'll be full steam ahead.
Okay. Paul, two very interesting ones for different reasons, but you know, kind of same but different. If I can say
There's parallels. There's parallels, but different. Yeah.
there is parallels. But if people wanted to maybe find out more about Acorn, I think it's worth mentioning here as well. You know, you guys have got the listed investment company side, and you've got, you know, the managed fund side. So maybe just talk to us about, you know, the two vehicles quickly, and kind of the strategy that overlays kind of, I think, you know, both vehicles.
Yeah. So Acorn Capital, we were established in '98, and we're a specialist microcap manager. We have a team of 8 research analysts who we cover every industry, and we're looking for the most attractive risk-adjusted returns in each economic industry. And that research process really is the foundation of all of our stock selection decisions across the range of products that we manage. We're a pure bottom-up, fundamentally based investment manager. So we have a pure listed micro opportunities fund called MOF for short, and that really looks at, so it takes the same investment process, but really just looks at companies below 500 mil market cap. We also have ACQ, which is our listed investment company. That has a broader mandate that can invest into companies really it's $1 billion market cap and below, which really is our microcap sector, is companies outside the largest 250. And it also does unlisted investing. So up to 30% of that portfolio is unlisted. The Micro Opportunities Fund is pure listed, X500 mil market cap, and has a very, it's going to be capacity constrained. It's going to top out at $100 million. So there's a liquidity aspect that we would potentially look to take advantage of shorter-term trading opportunities if they were to arise. But at its heart, both those products are supported by the same team and the same core investment process.
And just on the Micro Opportunities Fund, retail, wholesale?
Currently wholesale. But early next year, we are in the process of going retail, and I would expect, if our timeline goes to plan, it'll be early in 2024 that it'll be open up for retail investors.
Okay, perfect. And it's ACQ, the ticker on the listed investment company.
That's it, correct.
Okay, perfect. Paul, thanks very much for joining us. Great to have somebody from Acorn on, and yeah, we'll keep an eye out on Microcaps and ImpediMed over the next 12 or 18 months. They definitely both seem at an interesting juncture in their kind of listed lives. And yeah, hopefully we can have you back on maybe 2024, maybe an update on the two of them and maybe 2 new ones.
Yeah, that sounds good, Mark. This has been fun.
Okay, thanks, Paul.
Thanks, guys. See you, Mark.